Determine full-time equivalents and full-time employees. We will begin in just a few short moments. Good morning, everyone, and thank you for joining us for today's webinar, How to Determine Full-Time Equivalents and Full-Time Employees, presented by Anita Baker, Managing Principal of Clifton Larson Allen's Employee Benefit Plans Practice. At Clifton Larson Allen, Anita specializes in providing assurance, tax, and consulting services to plan sponsors and third-party administrators. In her position, she is responsible for CLA's National Employee Benefit Plans Practice and is a leading consultant on the impact of healthcare reform on group health plans and employers. Today, Anita will provide you with an overview of which companies qualify as large employers, and will discuss the IRS safe harbor methods to determine who is a full-time employee for purposes of health coverage and assessment. At the end of the presentation, she will be fielding questions, so be sure to submit your questions using the chat feature in your control panel. The presentation will be posted on AAIA's Online Healthcare Resource Center shortly after the presentation. Thank you again for joining, and with that, I will turn it over to Anita.
Thank you, and good morning. As Melissa said, we are going to talk about the Affordable Care Act today and how to determine full-time employees and equivalents. But first, I'm going to just give you a little bit of a background. I'm sure you're all very familiar with this by now. There's a lot in the news these days about the Affordable Care Act. You can't really miss it, but it has been around for a couple of years, and there's been a lot of additional laws and regulations that have been passed within the last year, just clarifying some of the rules related to the individual mandate and also the employer penalties and responsibilities. So it is the law of the land today, and it does apply up to all businesses. Also, you're probably aware now with all of the exchanges that are opening for enrollment October 1st, that they will be in place January 1st of 2014, and almost all individuals will be required to obtain that health insurance coverage or pay the penalty. And that has kind of been one of the debates recently as to whether or not to delay that individual mandate from 2014 to 2015, because in July, the Treasury Department did announce that it was going to delay the employer shared responsibility penalties and the mandate that employers provide insurance, large employers. It did delay that until January 1st of 2015. So in 2015, to be subject to those employer shared responsibility penalties, an employer must have 50 or more full-time employees plus full-time equivalents during the preceding calendar year. So it's really important now to examine your workforce and look at how you count full-time employees and equivalents, because you would, if you are that large employer, then you would be subject to those penalties in 2015. And the reason why we're talking about it now is because a lot of it relates to how you identify those workers in 2014. So I know we're still in 2013, but it seems like the time is going by really quickly. So we're trying to, give you information well in advance so that you can understand what you may be facing in the future. Now, these employer shared responsibility penalties They're only assessed if a full-time employee goes to the exchange and gets an exchange subsidy. Now, they would be ineligible for those subsidies if the employer coverage is affordable. So you probably hear a lot of talk about affordability. Of course, it's called the Affordable Care Act, so affordable is kind of a key term. And what that really means is that the IRS has really defined that through some safe harbors. How it was defined in the law was that the employee contribution would be less than 9.5% of household income. But now there's a few IRS safe harbors that basically says if the employee premium contribution for single coverage is less than 9.5% of their W-2 wages, then it's affordable. And the reason that's important is because the penalty, again, is only on those who go to the exchange and get a subsidy, and the only way they can get the subsidy is if they don't have an offer of affordable coverage. And one thing I was thinking about was really that with the delay in the employer mandate, it also delayed the reporting requirements for employers to report whether or not they offer affordable insurance. So with the individual mandate in play and people going to the exchange, there's no verification process to check if the employee actually does have affordable coverage or does not have affordable coverage. So there's a little bit of a glitch in the law for this 1 year where the reporting is delayed, but the subsidies are still available. So that's where it could get a little interesting to see, who applies for those and whether or not they in fact are eligible or not. But the key is that in 2014, if an employee does go to the exchange and gets a subsidy, even if they're not supposed to, that you would not be penalized as a large employer. So the two penalties you'd be worried about in the future would be the no insurance coverage penalty, and that would be $2,000 times each full-time employee after the first 30. And again, if at least one employee goes and gets that exchange subsidy, you'd be subject to this entire penalty. So after the first 30, it'd be $2,000 per full-time employee. And then the unaffordable employer coverage penalty is really if an employer has coverage, but they fail to provide this minimum value coverage, which is equated to 60% actuarial value. And really all that means is that the plan is paying 60% of the cost. So like if you go to the doctor and it costs $100, the plan pays $60 and you pay $40. That's really what it means in simple terms. But you have to offer that minimum coverage to all your employees and their dependents, or you would be deemed to not offering, not providing an offer of coverage. But the second piece is then that has to be affordable. So the employee premium cost, again, has to be less than 9.5% of income. And then if you don't meet those criteria, then you would be subject to this $3,000 penalty times the number of full-time employees who go and get subsidies. Again, it's only those that go get subsidies because they don't have an affordable or minimum value offer of coverage. So that's just a little background. It tells you why it's important to understand this full-time employee piece because, first of all, to know if you're it's changing because full-time employees now are those that are engaged an average of 30 hours of service per week or 130 hours in a month. So, we always think of full-time as 40 hours, right? Well, that has changed, and that's why you see a lot of businesses reducing hours to less than 30 hours per week because they don't want to count those people as full-time employees for purposes of this law, which is a sad unintended consequence that I don't think was anticipated. You also can use the 130 hours in a month. And it does use the common law definition of employee, so it does not include leased employees, sole proprietors, partners, 2% S-Corp shareholders. So you don't have to include those, but everyone else that works an average of 30 hours a week would be included. Now, when you're determining whether or not you're over the 50 to be a large employer, you actually have to add your full-time employees to the full-time equivalent calculation. So what that is, it's basically taking all your part-time employees' hours for the month, and it doesn't exceed 120 hours per employee. So you basically take all their hours. If they worked 130 hours, you use 120 hours. But you add all those up, you divide by 120, and that's the number of full-time equivalents you have for that month. And again, you're looking at an average of the preceding year. So what you want to do is you just basically want to add up your full-time employees plus your equivalent on a monthly basis and then determine if you have 50 or more on an average basis. So that's kind of the first calculation to see if you're over the 50 full-time employees plus equivalents to be subject to the penalties. And then you would be concerned at that point about who's full-time and how many hours of service they work for going forward. So, and I know this is probably the most complicated subject that we talk about because the regulations came out and they were very difficult and hard to understand. They did give a lot of examples, however, so there is a lot of good guidance in there, but when I first read it, I was kind of like, oh, are you kidding me? This is just really, quite complicated. So I'm going to try to make it, as less complicated if I can. But again, keep in mind that you may need to do a little research too on yourself, just determine how some of this applies to you. But first of all, just defining full-time employees and equivalents. So an employee, just kind of some side things. So an employee serving as an employee and a director for an employer would be an employee. So anyone really that gets W-2 wages and works for you as an employee. And also related businesses such as a control group or an affiliated service group or different lines of business, they're really treated as a single employer under the rules. So you have to actually add the employees of all the entities, and you have to take all of the employees into account as part of that control group, only for the purpose of determining whether you're that large employer with over 50 full-time employees and equivalents. So that's just to determine large employer status. Once you determine you're large, then each business on its own would be responsible for the offer of coverage and making it affordable and so on. So it's treated separately for that purpose, but together for determining large employer status. So the hours of service rules are used to determine whether someone's a full-time employee, and so it includes all work for which employee receives U.S. income, so it doesn't include foreign income or hours worked outside the United States. It includes each hour which they're paid or entitled to payment. So it also includes like leaves, of course, vacation and holiday and illness, disability, jury duty, military, or other leaves of absence. You have to count those hours. So it's not just hours worked, it's hours paid or which they're entitled to payment. And then you also calculate the hours of service, based on both worked and those paid. So, and then also you have to use kind of a reasonable method for crediting hours of service. If you don't keep track of hours, because I know, like, I'm in accounting and we account for every single hour of the day, so we definitely keep track of hours. But some companies, if they're just paid on a commission basis or they're paid, transportation employees, I know a lot of pilots and airline pilots, well, they might not work, the 30 hours in a week, but they have a full-time position considered. So you have to actually just look at those different examples in the law. And for example, it wouldn't be reasonable to not take into account travel time if you had a traveling salesperson that he was compensated on commission. So you would take into account basically his travel time and the time that he spends on the sales floor and those kind of things. So this is why it's important that you understand kind of that threshold for full-time and who you have to count as full-time. And certain situations like this, you may need to, look a little bit more in the guidance and the regulation to determine. But I would always err on the side of determining that someone is a full-time employee versus not, because you don't want to miss offering someone coverage that should have had coverage, because that could be problematic in the future. So there's different methods for determining full-time status, and the thing about this is that the assessments from the exchanges, I understand, are going to be on a monthly basis. So they would assess employers based on the employees that come to the exchange, get a subsidy, then they would send back an assessment to the employer on each of those employees, but it's on a monthly basis. So, I mean, one way you could say, well, you could do a month-to-month method, and you could just say, well, this month we have, 60 full-time employees. Next month we have 50. You can go month to month, but that really is problematic because, you don't want to have to be offering coverage every month or enrollment every month, and you can't really say, well, this month they worked over 30 hours, but next month they're under, so I'm going to drop their coverage. I'm not going to cover them, and it would be really administratively difficult and problematic. So what the IRS said is that we're going to give you a look-back measurement period, and it's a safe harbor method which involves counting hours of service in the past to see if they're averaging at least 30 hours of service per week. And then you use that method, and you use it for new employees, use it for ongoing employees. So that's what we're going to talk about, is this look-back measurement period. And that's why it's important in 2014 that you start using this measurement period for 2015, when you actually have to report on who's full-time and who's not. So the IRS did issue this safe harbor notice, and it said that there's 3 different periods. There's a measurement period, administrative period, and a stability period. Now, the measurement period can be 3 to 12 months, and the employer can determine that period. So you can choose how often, I guess, you want to measure hours. And after that follows by an optional administrative period, which would be up to 90 days for you to enroll employees, notify them that they're eligible, get them enrolled and into the plan. And then the stability period is the greater of 6 months or the duration of the standard measurement period. So if you chose a 9-month measurement period, the stability period would be 9 months. And if you chose 12 months, it would be 12 months. But it can't be any shorter than 6 months. So if you do a 3-month measurement, it has to be a 6-month stability. That's the period where you're covering your full-time employees. So you measure their hours, you look back, you determine who's eligible, you enroll them, and then you cover them for the next 6 to 12 months, regardless of how many hours they work in the following 6 to 12 months. So the key terms in this, obviously, are the measurement period, the administrative period, the stability period. And so those periods, the measurement and stability period, must be uniform for all employees, but you can use different ones for different groups, like, for instance, each group of collectively bargained employees or collectively bargained and non-collectively bargained. So if you have union employees and non-union, you can actually use different methods for union and non-union. You can use different methods or periods for salaried and hourly, and then also located in different states. Now, again, the more different you use, the more complicated I think it gets. So you want to be sure that you're making a good decision from an administrative standpoint. And again, this may not be that big of a deal if you know for certain who works full-time and who does not. Then it's pretty easy. But if you have a lot of variable hour employees or seasonal or things like that, then it gets a little more complicated to measure those hours. So for ongoing employees, so they kind of split it up into ongoing and new employees. So an ongoing employee's full-time status is determined by looking at the measurement period where they average at least 30 hours of service per week. So if they do have that, then you consider them a full-time employee for the stability period. Again, it has to be at least 6 months, and that's where you would be covering them. So employees that did not work full-time during that measurement period would not be considered full-time employees, and so you would not have to cover them, of course, in the stability period. And again, this administrative period is really optional. It's to help you kind of have that, you know, overlap to get people enrolled and things like that. So again, the standard stability period is a period of time following the measurement period where an employee treated as full-time, regardless of their hours during the stability period, then you would cover them. So again, it has to be at least 6 months or the standard measurement period. So again, I know this gets a little bit confusion, so I'm going to give you a couple examples. So an example would be an employer uses a 12-month stability period that runs a calendar year, which would be typical for, say, a calendar year plan. You're going to cover your employees from January to January 1st to 31st. So the measurement period, you would actually run it from October 15th to October 14th, and then your administrative period to enroll them would be October 15th to December 31st, and then their coverage would be effective in January. So, for example, if an employee is an ongoing employee and currently covered in the health plan, you would measure their hours in that measurement period, and if they did work an average of 30 hours per week, it would continue through the end of the stability period, again, through December 31st of 16, and then they would enroll in coverage for the next stability period. So again, a little bit confusing, but if you look kind of at this, it's like you have this stability period, but you have to kind of measure it and then enroll them and then cover them continuously if they're full-time. So another example would be if an employee worked an average of 28 hours during the measurement period that ran from the October 15 to 16, and he was already covered, so his coverage would continue. However, he would not be given an opportunity to enroll in coverage for the next stability period, which began in 2017, because he did not meet, again, he worked the average of 28 hours in the period through October of 16, so the next period he would not, again, be eligible for the coverage or covered in the next stability period. So this just shows that, the hours are dropping with 28 in that period, so then come the next year, then they would not be eligible for that. So seasonal employees are a little, again, I don't know if any of you have seasonal employees, but this is a little bit different. Now seasonal employees, basically they say if an employer has employees that work for a period of 120 days or less, and it's really due to seasonal workers, you can actually exclude them for purposes of determining whether you're over the 50 employees. So you exclude them for purposes of whether or not you're a large employer, but you still have to consider them. If you are a large employer, you would still consider seasonal employees and measure their hours to see whether or not they fall and qualify for coverage. But if you have that, it may help you stay under the 50 employees. So there's new employee categories. You have new employees that have been employed, less than a year or less than the standard period. You have a new full-time employee who they're reasonably expected to work and be full-time, and they're not seasonable. And then a new employee also, if an employee goes at least 26 consecutive weeks without working, and then they come back or return from leave, then they might be treated as a new employee. And the reason it is important because new employees have to start measuring when they are hired, and so it's a little bit more confusing when you have a new employee. So you just want to know there's different types of new employees that you want to look at. Now, a new variable hour employee would be someone where you can't determine whether or not they're reasonably expected to be employed at least 30 hours of service per week during the initial measurement period. And then, again, if there's special unpaid leaves, there's different rules. And again, I'm giving you kind of these slides to tell you what some of these rules are. We don't have a lot of time today, to go over that, but you basically have to look at their average hours of service a week during a measurement period that excludes the leave, and then you would actually treat them and credit them with hours of service during the leave. So if you had someone that worked, 35 hours a week and then they went on leave, you would have to consider that they would continue to get that rate of average weekly, and so that you would not consider them to drop below the 30 hours full-time. So new employees, as far as determining whether they're full-time, you determine that at the date of hire. So if you think they're going to be full-time, you pretty much know that, and you have to enroll them within the 90-day waiting period under the law. So that would be determined at the date of hire. Now, a new variable hour or seasonal employee, if you use a look-back measurement period for ongoing employees, you can also use this for new variable hour and seasonal employees. And what that really means is that when a new variable hour and seasonal employee starts, you have an initial measurement period, again, what you select, that begins on the date between their start date and the first day of the calendar month that follows their start date. And then you actually start initial measurement period for these new variable hour and seasonal employees. So, and then once you do that measurement period, again, you can have the initial administrative period to enroll them if they're considered full-time. But the initial measurement period plus the administrative period cannot exceed 13 months. So it has to be you have to offer that the first month starting on or after their 1-year anniversary of their start date. So just keep in mind, you do have, for those that you don't know if they're going to be full-time and you think they're going to have variable hours, you actually can put them in your initial measurement period. You don't have to offer them coverage within the 90 days. You can start them on the measurement period, but then you have to offer them, if they're full-time, you have to offer them on the first of the month after their 1-year anniversary, so you can't offer it later than that. And then the initial stability period would be the time that the employee is treated, either full-time or part-time, depending on the measurement period. So if you determine they're full-time, then you have to cover them again at least 6 months. If they're not full-time, then you don't have to cover them basically at all. Now, if you have a change in employment status, this changed to new variable hour and seasonal employee. So you're kind of thinking, well, I hired someone and I thought they were variable, but now they have a change in their employment status, so they should be treated as full-time because they went over. Then you have to offer them coverage for the first day of the 4th month following that change in employment status, because then they turn into basically full-time status and you're into that 90 days. So you also kind of have to watch that. Again, rehired employees are those returning from a leave of absence. Then you can treat them as a new employee if they're not, credited for hours if they're more than the 26 weeks. So more rules on that. Again, I'm not going to go through every single thing, but there are specific examples and specific rules on kind of the rehired or the returning and kind of how you treat them and how you calculate those hours of service while they're on the leave. And again, it's basically using an average method or crediting them with those hours of service at the same leave or the same rate that they would if they were working. So kind of put this all together, again, the reason why it's so important to understand which employees are full-time is because employers must offer, large employers again, must offer full-time employees and their children under age 26 that health insurance in 2015 or pay the penalty. The penalties are only assessed on full-time employees. And then, so the strategies as far as selecting the correct measurement or stability periods, some people say, well, let's select one that captures the fewest number of full-time employees. That's okay, but realize that it's a rolling measurement and stability period. So as soon as you end the measurement period, you start another one. So you're going to capture them eventually. So I don't think that that's the greatest strategy. The other one I've seen is limiting employee hours again to less than 30 hours a week or 130 hours per month. Again, some employers don't really have a choice because they can't afford to offer coverage or they can't afford the penalty. So they really are saying my only option is to reduce hours, less than 30 hours a week. And I've had a lot of personal examples of this, of people that have talked to me and said they have their hours reduced. So it is actually very real. The other thing is you could limit the number of full-time employees to 30 because when I told you about the penalties, the no insurance and the employer penalty if you provide insurance, you take the lower of those two penalties. So if you have only 30 full-time employees, the no insurance penalty is 0 because you get 30 free. So then your total penalty is 0. So, you may actually want to look at the number of full-time employees you have, and if it's close to 30 or, I had one client that had 51 FTEs, so he was subject to the penalties and the providing coverage, but he had 27 full-time employees, so therefore he didn't have any penalties. So there was no point. He basically said he's going to drop insurance because he has no penalties to do that, and it would cost him less to maybe compensate some of the people that he had covered in the past. So these are just different things to think about as you're looking at how many full-time employees you have and looking at their hours worked. So really what we recommend now, and again, the good news is you do have more time. When this was effective January 1st of 2014, we were getting a lot of panicked clients in 2013 saying, oh no, I have to do my measurement period now because it's going to count for 2014. Well, the good news is you have plenty of time to think about this and how you're going to do that in 2014, because then, again, it won't be effective till January 1st as far as the penalties and all that. So first of all, determine if you're a large employer. That's the main thing. Make sure if you have 50 or more full-time employees plus equivalents, then again, you're a large employer. That's a key. So then if you are a large employer, do you offer that minimum essential, minimum value coverage, and is it affordable to your employees and their children? And again, it only has to be affordable for the employee. So if you are a large employer, you should evaluate the cost of not offering coverage or continuing to offer coverage. We do have a health insurance and penalty calculator. The website's on the slides. It's called HIP. And we basically, with AAIA members, we have a discounted rate to help you evaluate that cost in the future. And then really just looking at your current systems for tracking wages and hours and premiums on a weekly and monthly basis. And you really will need that if you're using that look-back measurement period in 2014. And also in the future, you're going to need to report that information to the IRS. Fortunately, that was delayed, so that is not effective again until 2015. So you do have time. I guess the good news in this whole thing, it is complicated, but you do have plenty of time to look at it now and determine how you're going to approach that. So with that, I think that is all I have, Melissa, and see if there's any questions.
Thank you, Anita, for that excellent presentation. It looks like we don't have any questions for today. Thank you all for attending today's webinar. I'm sure Anita's information provided many of you with future advice to help you in your business. The webinar will be posted on AAIA's members-only online healthcare resource center. The Resource Center, which AAIA is hosting through a partnership with Clifton Larson Allen, also provides articles, Q&A opportunities, webinars, and discounted pricing for its health insurance and penalty calculator to help member companies navigate the issues of healthcare reform. Also on the site are a sample health insurance and penalty calculator report, Clifton Larson Allen's Healthcare Reform Resource Center with articles and other information for employers and individuals, and contact information for Anita Baker, Clifton Larson Allen's managing partner of employee benefit plans, so AAIA members can directly email her with specific questions. AAIA will be continuing its ongoing webinar series on the Affordable Care Act with information on the next webinar that covers the individual and large employer mandates and the penalties that will be assessed, scheduled for Wednesday, November 20th, coming soon. Members' AAIA login and password are required to access the online resource center. For more information, call AAIA Member Services at 301-654-6664. If you have any more questions for Anita, please send them to anita.baker@claconnect.com. Thank you again for participating.